Hi and good evening, everyone. Welcome to tonight's webinar. So we have a new product feature on FSMOne.com. I'm sure all of you are quite curious to find out what it is. For those of you who don't know, we're talking about a margin financing product this evening. And we have the person who is behind the product, 𝗪𝘃𝗀𝗀𝘀, to come and share with us more about how you can utilize this for your portfolios. So tonight's session will be a bit of an explanation on how the product works, how you can get started with it. I'll just hand over the time to Delton and he'll provide you with more information. If you have any questions along the way, please put them in the Q&A function. After his presentation, Delton will get around to answering all of your questions. So sit back, relax, and I'll hand the time over to Delton.
Hi, thanks, Jonathan. Hello, everyone. Hope everyone is having an amazing evening. Just let me share my screen first. Okay, so yeah, without further ado, let's start. So hi everyone, I think that I can start by giving an introduction for who I am. So my name is Dalton. Welcome to this evening seminar on all-new product financing to uncover the versatility of margin. So I'm with the FSM product team. Actually, this product has been in the works for over 1.5 years now. And I think tonight we are really excited to showcase some of the features of this product financing. How does it differs from the margin facilities that you may be familiar with? And lastly, of course, we'll bring you through what you can expect to see on the FSM portal, what are the changes, what are the new changes pertaining to product financing. Right, let's start. Okay, so just here's a disclaimer, which I'll just put here for a few seconds. It goes through what I will be sharing through this evening. Yeah, so you can just take a few seconds to read it through. Okay, now, so for those who are not familiar with product financing, so what exactly is product financing, you may ask? So basically, product financing or investment leveraging is the act of borrowing money. You borrow the money to finance a larger investment position in the market. So this is actually secured. It's a secured lending facility that is by pledging the client's investment products as collateral. So when you pledge this as collateral, you can get in exchange for a higher purchasing power. Now, of course, use of leverage is always a double-edged sword. While it could increase your returns, it could also magnify the losses should they go against you. Now, some of the clients may be familiar with some of the loans that are currently in the market. We have two types of loan generally revolving around this kind of product. One is a Lombard loan and versus a margin loan. So Lombard loans, so just to differentiate the difference between these two loans, Lombard loans are generally offered by banks, and margin loans are generally offered by brokerage firm. But by and large, both are the same type of loan whereby it is a secured facility by investment products. So you can pledge your bonds, stocks, ETF, unit trusts, or other financial instruments. So what typically do is that the financial institution will apply a haircut on the valuation of these assets to derive the amount that the clients can draw upon, that clients can borrow. Now, another difference is the fixed is the tenor type. For bank loans that you may be familiar, you pledge your investment asset. Usually, you take on a loan that is a fixed tenor, like one week, 1 month tenor, and you may have the option to roll over upon maturity. So when you roll over, you typically pay off the interest and then you roll over the principal. So for margin loans, typically there's no fixed tenor, and loans can be repaid at any point of time, because on every daily basis is rolling over. So the main difference is that the drawdown method is different. For Lombard loans, you may be familiar with the banks. Typically, when you pledge your assets, you can draw down in cash. So when you can draw down in cash, it offers the flexibility for clients, because you can use this cash to buy, you can use it for personal reasons, such as you can buy a property, you can buy a car. There are basically no restriction. But in terms of margin loan, we grant the drawdown in terms of purchasing power, where clients need to invest in products. So they cannot directly make a cash withdrawal. However, they can still indirectly do so, through a series of transactions, and then you can just do a withdrawal. So this is a simple illustration on leveraging. So let's say assuming client's portfolio have the this amount of assets. So without leveraging, you can see that they are only capped by the amount that they can purchase up to the cash account holdings level. So let's say the cash, this client have $50,000 cash. he's able to leverage up to he's only able to purchase up to $50,000. And capital gain and loss is based on the fluctuation of the asset class and of the product. Now, if you have leveraging, so the buying power then in turn is increased because you are pledging your assets and you are buying a larger position. So for example, if this client is buying up to $250,000 on margin, so the loan borrower is also $250,000. So naturally, if the NAV of, let's say, the product that he or she is financing in increases by 10%, you can see the capital gain is increased. So if, let's say, the gain is $25,000, actually this translates to around 25% of the capital, whereas if without leveraging, the capital gain is smaller. So if, however, since it's a double-edged sword, if, let's say, the NAV of the financing product drops by 10%, the capital loss without leveraging is only capped at whatever that the client has invested, but they may potentially, with leveraging, they may lose up to the initial capital. So you can see a small 10% drop is actually accounted for 25% of the initial capital based on the $100,000 asset. So I hope this illustrates the relationship between how you can leveraging, while you could increase your return, but you could also increase your losses as well. So you may think, since the risk is there, why would clients use margin? And why would they use FSM margin? So if you're a client, you are wondering, actually there are three main reasons. First is really to boost your purchasing power, because as you can see from the earlier example, $100,000, you can only buy up to $100,000. But with margin, you are able to potentially buy up more than what your initial capital has, which is $100,000. You can buy up to, let's say, $250,000. So secondly, there's no cash outlay, because the entire investment portfolio, you can just pledge your investment assets. So you don't need to pledge any cash. So using the collateral as your investment portfolio, you can then use it to finance in other products. So basically, there's no cash outlay. So third, some of them use it to generate income through positive carry strategies, which I can share more on it later on. Okay, so this is an info page, is an infographic that we can actually share. So it's actually the product financing. So it's a multi-asset, multi-market, and multi-currency facility. Multi-asset because we do it on a portfolio level where we can accept all the marginable assets. So who is eligible? Currently, it's open to FSM plus prestige clients who are accredited investors and at least 21 years of age. We also welcome all foreigners. There's no minimum AUA requirement. So even if your account has only like $5,000, $10,000, it is also eligible. So we do not impose any minimum AUA requirement. So for FSM, we are opening this to both the personal and the banking accounts. And in terms of what products are marginable, essentially all the cash, unit trusts, 381 unit trusts, 1,800 bonds, and more than 6,000 stocks and ETF. So you offer up to 3.5 times leverage. This is in line with industry standard. So this translates to actually 71.43% financing. Now you may find this figure is a bit weird because actually this is just based on MAS regulation. All brokerage firms can only go up to 3.5 times leverage at the max. So you can, on the table on the right, you can see the financing rates. Currently, we have a special promotion on SGD, USD, and HKD. So these are the discounted rates after discount, and these are the rates for other currencies. We also offer JPY financing for those who are interested to leverage into Japanese equity, or you can do cross-currency financing, but it's a more advanced strategy. So approval process, our facility is instant approval, and we can do immediate margin drawdown, which I can share more on it later. Right, and here is the promotion that currently ongoing promotion on FSMOne that we were actually mentioning about. So you may have received some EDM on this as well as some notification. So in effect, you can get up to 1% off. Yeah, it's 1% off the prevailing board rates. So it's 4.5 for Sing, 5.9 for both USD and HKD. Now, we also did a comparison across 10 local brokerage firms. The industry average for Sing, USD, and Hong Kong Day is actually higher than what we are currently offering for our promotional rates, from up to 10 to 41% lower, depending on the currency. So actually, this is a good time to actually try our facility if you haven't already. So now I will elaborate more on how our facility differs from the traditional margin facilities that you may be familiar with from other brokerage firms. So first, we actually offer an instant opt-in process. Now, if you go to other brokerage firm or let's say banks, for example, it's based on product level. And if let's say you are interested in stocks financing, you have to open a share margin financing account. Now, typically what you do is that you submit a account opening form. You go to the maybe bank. You need to provide your supporting documents like your income payslip. You need to sign, a lot of pledge agreements, pledging forms, and only thereafter it will be internally reviewed by their credit team, and then the account gets opened, which takes an upward of say a few working days, or maybe up to a week. Some of the margin accounts also imposes a minimum balance where you need to deposit, they say 2,000, 3,000 USD before the margin is activated. So here at FSM, everything is all digital, and we want to keep things simple. As long as the client meets the eligibility criteria, which earlier mentioned is FSM Plus Prestige and above 21 years of age, immediately you are able to go to the portal, click on the account that you wish to opt in. It's on account level, and just click on opt-in. So after opt-in, you can just have to go through some declaration, which is just viewing the T and C and all that, and instantly the account is opt-in. So there's no additional account opening. You can just use the existing account to opt-in to margin, and it's instant approval. There's no forms, there's no face-to-face appointment, there's no supporting documents, and the third point is that there's no time lag. So you can do everything within the same day. You opt in, you can immediately utilize the facility. You can immediately do a margin drawdown. So that's how simple and straightforward it is. So second is unified margin buying power. So what do I mean by this unified margin buying power? If you look at the market out there, it's by product level. You want to open a stocks, you open a share margin financing, you open a bonds financing account. So if let's say you have different asset classes, you will have to manage 3 different margin accounts. You have to perform internal funding, internal transfer of assets. So it is very hassle for the client. And for FSM, we want to do everything within the same existing account. We look at it on your portfolio level. So all the client's portfolio is determined, can be pledgeable, UT, funds, bonds, everything. So we will determine the margin buying power based on the whole entire portfolio level, and we will then accord this portfolio where you can then have the ability to cross-finance across different products and different currencies. So in the past, let's say if you want to do a switching, for example, you're holding on to a unit trust, you want to switch to an ETF. And what happens with a cash upfront model is that when you're switching from a unit trust to an ETF, unit trust takes 7 days to actually settle. And when you buy an ETF, it takes 2 days. And you realize there's a funding gap of 5 days. So back then, you have to wait for your cash redemption proceeds to be in to your cash account before buying the ETF trade. So this means you are 5 days out of the market. Now, with margin, you are able to perform same-day switching into different asset class without time off the market. You are able to immediately place a margin buy following after you sell the unit trust, because once you sell the unit trust, your margin buying power will be increased immediately. You can then buy the ETF, and you can just fund this few days with margin. It's okay, the interest wouldn't amount to a lot because it's just a few days. You can just repay it once the redemption proceeds are in. But the best part is that you no longer have to be timed out of the market. So third is a multi-utility cash account. I think this is the big difference that traditional, if you're a client who are familiar with the traditional brokerage firm margin facility, so it's something new. So current market practice is, let's say if you have $50,000 in your cash account, you create a margin buy for $80,000. And what will happen is that they will wipe off all your cash balances. So your $50,000 is wiped out, and then you will then take on the loan of $30,000. So since, cash is always depleted before using margin, you realize that in the margin account, you can't use the cash for other features, like you're doing your debit card spending or doing FX, because it's always zero. So for FSM, in FSM, we want to offer the full flexibility in how clients use their cash account, even when the loan is being drawn. So we have introduced a new payment method called margin, which does not impact your existing cash solution. So for example, let's say you are able to place you want to place the margin buy of $80,000. Same scenario, $50,000 in your cash account, place a margin buy for $80,000. You realize that your cash balances will remain intact. You can then use these cash balances to further invest into any product using a cash buy. You can then spend on your FSM debit card. You can spend, let's say $5,000, then your cash account balance will reduce. You can perform a withdrawal like how you are normally doing. And only after that, you can, you decide to repay because you want to make a loan repayment. Yeah. So the thing about that is that when you are able to make a repayment, then as soon as you repay before the cutoff time, no interest will be charged. And in the instance whereby you are tight on liquidity, you do not have enough cash, you are able to use this facility because you can pay on margin first. Because you are able to purchase the asset on margin first, and you can repay anytime. So before the trade settlement date, as soon as you repay, a repayment is made, no interest will be charged. So this one, there's a slide on this. I'll elaborate more on this later. So cash withdrawal, if you're familiar with the brokerage firm practice, is that typically when you have no cash balances, you can't do any withdrawal, right? So what will happen is that when a client do a sell, they will have to call into the hotline to apply for cash withdrawal, maybe submitting a form to see how much how much you can withdraw. So this is manually processed by the credit team and to see how much you can withdraw out. Now this is a very manual process. It's a operations team will have to go through all the application for the cash withdrawal, and it takes up to a few days. So for FSM, you can just do withdrawal like the same way you are doing it now. We do not have any forms required for you to fill in before you do a withdrawal. So what we have done is just adding a new checking in place. Whenever you're doing a withdrawal, there's actually a max withdrawal amount that is pending there. So this is basically it's just to check how much you can withdraw without breaching the margin requirements. Yeah. So you can see in this example, I have $1,300 in my cash account, but if my max withdrawal is 0 because perhaps my margin ratio is really at a risky level. So this system doesn't allow me to withdraw. Yeah. So it is able to compute on the fly to see how much the client is able to withdraw. So last is actually the fast fee. It's actually a fast free credit limit increase. So it says, for example, you want to increase your credit limit. Typically, with other banks, brokerage firm, what you have to do is to submit a form, you have to call in the hotline, you go to the branch, you provide more supporting documents to prove that you are eligible for this credit limit increase. So for our facility, all clients will start off with an initial credit limit of $500,000 Sing. Now, this is on NRIC level. It applies across all platforms for FSM and for iFAST platform. Now, depending on the amount of assets you have with us, clients may have millions of assets. You may require then a higher credit limit. And how do you do that? You do not do it over the form or do it through call us. You can just do it on the portal. You can just do it on your mobile app. Just click on increase on the maximum margin. So after you opt in, you also prompt you to ask whether you need a higher credit limit. So of course, all credit limit increase will be subjected to approval, and internal process will be run through the amount of assets you have. Then after approved, then we will adjust your limit. So once the limit is adjusted, we will inform you that your credit limit has increased. Yeah. Okay, so now moving on to some of the more technical area with the margin concepts. Because you may be, if you are using our facility for first time, there may be some of the margin jargons that you may not be familiar with. So I'll just take the next few minutes to just run through very quickly some of the concepts so you can be bring up to speed. So there are 5 margin concepts that I wish to convey today, to share more about today. So the first is the market value versus collateral value. You may be familiar with market value because it's what you have been seeing on your portfolio. Now, collateral value is what we would apply a haircut to value the collateral at a discount. So now you may ask, why do we want to value the collateral at a discount? It's basically for the financial institution to cater for price fluctuation and market decline. So for our side, it's a safety buffer. Yeah, so just think of it as a safety buffer to derive the collateral value. Now, loan to value, LTV, you'll see this very frequently on the portal pertaining to margin. Now, what is LTV? It is the applicable haircut to value your assets at whatever the collateral value is. So when you see something that's 70% LTV, that means we are valuing 70% of the market value for this particular product. Now, on the flip side, it is also the maximum financing quantum you can take. So when you see something with 70% LTV, it just means that client just have to put up 30% worth of their capital. So our max leveraging, as mentioned earlier, is 71.43. So this means that client just have to put up 28.57% worth of client capital. And the lower the financing LTV, the more client capital they have to put up. So when you see something that's zero, that means you are using 100% of the client's capital. So that means these are all the non-marginable assets. So maximum margin is a term that you may also be seeing if you're just opted in. So what is maximum margin? It's basically just an indicative buying power or margin. How much buying power do you have at any point of time? Now, how do we derive is based on a multiplier on the collateral value of assets. Of course, different products have different LTV ratio. Now, if you buy a jump bond versus you buy a very money market fund, so different product will have different LTV, which translate to different buying power. So actual margin is then how much you can actually buy based on the product's LTV. So this figure will only appear when you are placing a trade. Last but not least, margin ratio. How do we compute how safe is the margin ratio of the account is at the current time? And how do we compute this? Is by a very straightforward formula, loan divided by the collateral value. As long as this percentage is below 100%, the client is safe. Otherwise, if it breaches 100%, margin call will be triggered. Okay, so you may ask, how much can I buy on margin? Now, it depends on two factors, really. First is based on the collateral value of your portfolio, applying a multiplier on it, but it's also limited by the amount of credit limit that FSM has granted. So just a very simple example, client A, he may have 10 million worth of assets, EUA with iFAST, with FSM, client B, $10,000. So after applying a haircut, and based on the initial credit limit that FSM grants of $500,000, so the maximum buying power is actually is gated, because even though you have millions of assets, this client may have millions of assets, but it's also gated based on the credit limit that iFAST is giving. And for client B, you can see that it's 3.5 times based on the collateral value of the assets. So the lower of the credit limit or the multiplier applied on the collateral value, which is $24,000. So second, how much they can buy is based on the product LTV. The higher product LTV, that means client can buy more. Lower the LTV, you are able to buy less. How do we charge interest? So very straightforward. We just take the loan times the interest rate divided by 365 days. So just some points to clarify. Since loan interest is only charged on the trade settlement date, any repayment made before the trade settlement date will not incur any interest. Secondly, loan is charged on a daily basis. So it's added to the loan balance on a daily basis. So every day you will see the loan amount increasing. And since there's no fixed tenor, unlike the banks, there's no monthly repayment obligation. So FSM does not actually bill or invoice client on a monthly basis for interest repayment. So basically, margin loan will roll on indefinitely. And this is our margin ratio maintenance. How do we track the margin ratio maintenance? It's very simple formula, loan divided by collateral value. So just a simple example, if let's say your collateral value is 565, you purchase $1 million of margin. So that means your loan is $1 million now. Now, before that, how do we compare your collateral value? Is based on your initial collateral that you have deposited. What you buy, it will also form part of your new collateral. So now the new collateral I'm valuing at 50% LTV because it's at 50%. So I'm only valuing $500,000. So you add these two up, you can get the loan divided by collateral value, which is 93%. So of course, local just have to ensure that their margin ratio is kept at 100% and below. But for foreigner, there's an additional haircut. So this means that the amount that they can purchase is so low because they need to maintain a lower margin ratio maintenance. Okay, so just to touch a bit on margin call in case you are curious. So what is a margin call? Basically, it's when the collateral value of the assets declining in relative amount to the loan they have drawn. So what will happen? You will send SMS, email, app notification to inform of your margin call status. And you have 2 days to address the margin call. And how do you address the margin call? It's very simple. You can either do a cash top-up, you can do internal transfer of assets, or you may sell down your assets to repay loan. But of course, the first method to deposit additional cash is the most straightforward. So on the right-hand side, you can see our margin trigger points, which is basically the escalating levels of margin ratio. So the higher the ratio is, the more risky the client account becomes. So it will become a forced liquidation level when, let's say, the client has not addressed their margin call within 2 market days, or if not, the margin ratio suddenly shoots up from 100% to 120%. So this is a forced liquidation level. So once it breaches 120%, we will contact you to address the margin call within the same working day. Now, worst case scenario, we will also come in and add to liquidate on a best effort basis. Of course, we will be in touch with you first before any forced liquidation efforts will be taking place. So to address margin call, we also have this new add-on is available on the margin summary page. So to show you exactly how much that you have to top up to fulfill this margin call and restore the margin ratio back. So you don't have to do manual calculation. You don't have to call us to ask how much you have to top up during a margin call. All you have to do is just log into the portal, look at how much you have to top up. So when you top up, you make a repayment of loan, then the margin call is addressed. Yeah, so it's as simple as that, and it's more convenient to the client as well. All right, so that's more of the less interesting stuff. That one is more of the technical aspects. Now, the more interesting is how you are able to use margin to amplify your investment strategy. How you can use some of the strategy here, how you can use margin to actually better aid your portfolio investments and so on. So there are a total of 4 strategies. I'll just go through in briefly first. So the first strategy is the more commonly used method, which how people use leverage is basically you want to speculative growth, speculative returns. You see a stock that this stock may overperform, and therefore, but if let's say the cash that you wish to purchase, you want to have a higher purchasing power because you want to increase your return. So therefore, this strategy will be suited for you. Now, so let's take a look at this example. So let's say there's a stock. Now you are looking at a stock on SGX market with 70% LTV. So let's say this client has an initial collateral value of $100,000. So how much they can buy based on 70% is up to $333,000. So let's say this client decides to buy on margin $300,000 worth. How do we compute the margin ratio? Loan divided by collateral value. So this client is still safe, 96.7%, but it's at the warning status. Now, on a positive scenario, so since our SGD interest rate is charging at 4.5%, actually per annum basis, the hurdle rate is just 4.5%. If let's say the stock returns 9% over a 1-year period, then the client actually gain 4.5% because you less off the borrowing costs. So on this positive scenario, let's say assuming if this stock appreciated by 20% over a 90-day holding period, so it's a 3-month holding period. So this client actually saw that this stock will have the opportunity for growth. And indeed, after 3 months, the stock went up by 20%. So now the interest charges that based on 4.5% per annum on a 90-day period is computed based on $3,347. So of course you have to less off this because it's your cost of borrowing. And the margin ratio, if you realize that before that, when you buy, is 96%. After that, after this stock has appreciated, you may think, why did the margin ratio drop? It's because the collateral value has risen. It has increased, it has appreciated. So therefore, you have more safety buffer. So of course, this is a win-win because you are not at the risk of margin call, and you can also get the decent gains on your portfolio on this investment. So actually, your net gain based on this appreciation by 20% So you just take 20% times this 300% is you can net gain of $60,000. So $60,000 while it's your gain, is your revenue of this P&L, you still have to less off your financing costs. So as mentioned earlier, the financing interest charges is 3,300. So you minus this 3,347, you still net a gain of 56,653. Now this is based on this scenario. So of course, being responsible, we will have also to caution the flip side of the thing, the negative side of the thing. What if this stock depreciated? So you're wrong on the direction. Now, what if this stock further depreciated by 20% over a 90-day holding period? You still incur the same amount of interest charges. It's still $3,347 because the loan is still constant. But the margin ratio actually, once you since the collateral value has decreased, now there is not enough buffer, right? There's not enough buffer for the loan. So you enter into a margin call status. So margin call, you still have to top up the additional cash and you still have to address the margin call. And the net loss based on this example is actually 63,347 because you have to add in the interest charges. So it's a double whammy for the client. So while it could increase your return, it could also magnify losses. So this is the example to clearly illustrate this strategy to leverage for speculation. So second is the more widely adopted one. It's a more rational one, income generation via positive carry. So what is positive carry? Positive carry is when your returns generated from the investment is higher than the cost of borrowing. So in other words, let's say if your borrowing cost is 4%, your rate earned on the investment is 7%. It can cover my cost of borrowing. I'm still able to profit 3% on a per annum basis. So how investors utilize this strategy is that they will identify income generating assets such as a dividend paying stock, say a REIT, unit trust, or coupon paying bonds. So they leverage in these assets since the income is able to cover the interest cost. So just an illustration, let's say if these, based on these three products, bonds, stocks, yield, funds have a different yield. And based on our current FSM margin interest rates, so you less of this, right? You are still able to have a net interest income to profit with the spread. And so you may think this spread is not a lot. So later I have a slide to share how you can actually use this to extend it. You may also have a question if, let's say you may be familiar with using the bank's facility. The question is that, do I have to find a monthly dividend paying product? Because you can use the monthly dividend to offset the cost of borrowing. But you see, we do not impose any fixed tenor. We do not impose as a 1-month loan whereby you have to pay off your interest charges. FSM margin loans will roll on perpetually, and it's a flexible repayment schedule. So our facility actually offer this, you can choose your preferred payout currency. So you do not have to fixate on finding a monthly payout strategy. You can actually find maybe a quarterly dividend paying one or yearly paying one, because it does not matter. What matters is the overall P&L and the returns. Okay, so just an illustration. So let's say if you have $100,000 cash, if this client has $100,000 cash, he may invest in this US fund, paying out 8.1% per annum. So the net income to this client is $8,100. But this client does not need to stop there. He can further take it up a level to leverage to generate more income. So from this $100,000, you are able to generate $8,100. But you are able to pledge this asset, get the collateral value, and you can leverage up to $250,000. Now, this up to, of course, in actual scenario, it may fluctuate. It may depend on the product's LTV and also on the product itself. And based on this earlier shared 2.1% per annum, you are able to generate an additional net interest income. Let's say if this client purchased $200,000 of margin, they are able to generate an additional $4,200 per year. So based on just this $100,000 cash, you are able to generate $8,100 plus $4,200, which is around $12,300 per year. So of course, this strategy is not without risk. being responsible, we also have to caveat the risk for this strategy. One is the interest rate movement, because if, let's say, if your cost of borrowing increases, so your investment yield, your net interest income would no longer be 2.1%. It may drop to 1%, it may drop to 0.5%. Yeah, so interest movement actually is a risk for people utilizing this strategy. Secondly is the capital erosion. So example, if let's say the fund that you are purchasing in, the NAV keeps on dropping, so it keeps decreasing, then the collateral value will also decrease. So this may actually have a potential risk of margin call. Okay, so the third strategy, I guess it would be more of the more commonly used one, more practical one, in terms of you may not be comfortable with using money to borrow to invest more, but you wish to have a bridging facility. So what do I mean by that is that, let's say you are seizing a time-sensitive investment opportunity and you want to invest. So you can actually, since margin interest only accrues on the respective trade settlement day, bonds, stocks, 2 days, unit trust up to 4 days. As long as you pay before the trade settlement date, there's no interest that's being charged. And since loans have no fixed tenor, it allows for flexible repayment terms. So what's the benefit of this? In general, all in all is you no longer have to miss out on this kind of investment opportunity on time of the market, due to you may not have the sufficient cash on hand. You do not have to wait for cash deposit to be in. You are still waiting for your cash sales redemption proceeds to be in. You are straightaway able to place a trade on margin first, and you can repay later. So think of it as buy now, pay later, without any interest being charged, or minimal interest being charged if, let's say, you repay after the trade settlement date. But I believe this provides the much needed immediate purchasing power for you to seize any time-sensitive investment opportunity. So 4 is a more rational strategy as well. It's more of the efficient portfolio management. So what do I mean by this is that, let's say currently you have a portfolio. It's quite diversified. You have ETF, you have stocks, you have, based on product types, you are quite diversified. You are also diversified across different regions. But however, you wish to, let's say, diversify more into geographical exposure. Let's say this client wish to allocate a position in Japanese equity, but they don't want to sell down their bonds. They do not want to sell their US stocks. So actually what they can do is that they can utilize margin to increase the exposure into various asset class, but there's no cash top up. So this client do not have to top up additional cash. They do not have to sell down any of the assets. And so just one sample action is that, so based on this, assuming the portfolio value is $100,000, the collateral value $71,000, they can buy up to $250,000. So let's say for this client, they invest 2.2 million on margin into a Japanese equity fund. That this Japanese equity fund is a 71.43% LTV. So it's just investing a small amount, $20,000 Sing equivalent. So based on the result, you can see that now the Japanese equity UT has formed part of the portfolio, and it's actually, client has effectively diversified his portfolio with margin without any capital outlay or without selling any of the existing assets to rebalance into the Japanese equity fund. Just create a trade on margin, just place a margin buy, and that's it. You can just diversify your portfolio as however you wish. Now, since yen currently is at 2.07%, we believe that the hurdle rate is not high, because just to break even, you just have to achieve more than 2.07%. So if a client is bullish on, let's say, Japanese equities, if you are following our house view, then actually the hurdle rate is actually lower. Yeah. So since the loan will be denominated in yen, they do not have to perform any pre-trade conversion. So let's say if there's no margin, you still have to sell, you still have to convert your Sing dollar into yen, then you still have to place a trade. So in this way, you are just able to place a trade on margin, then you can effectively perform this trade immediately. Okay, so next few slides, we just introduce the new addition to FSMOne portal. So this is the last segment. Then I'll take on the questions. Okay, so opt-in, as mentioned earlier, is a very simple and straightforward process. What you have to do is just go to, let's say, any of the product, under product financing, click on get started. You'll be routed to the margin enrollment page, select the account you want, and you just have to tick on the declaration box. Yeah, so you can see from the GIF on the right hand side, the mobile app, you can just see that the client just have to agree to the TNC, key in the password, and the margin is ready for use immediately. Just as simple as that. So we also have added in a new payment method called margin. So this may be addition. So you view it once your drop-down box, click on margin purchasing power. It's a margin, which allows you to actually place the trade on margin. So it will actually compute the amount of buying power that you have. So for example, let's say on the left, 5,700. This is the amount that I can buy with margin. Now you can key in the amount that you want. So let's say they want, then you can see the loan that will be taking on is how much, what is the loan interest accrual date starting from, what is the amount that you'll be taking on. So once you key in the password, then it will show your confirmation page of the loan that you will be taking on. So it's again as simple as that. So margin summary page is also a newly added page. Provides a very concise information of your margin health in general. After you have opted in, you'll be able to view this module, this new page. This new interface will show you what's the collateral value, what is the, let's say, margin call amount if you're facing margin call. You even have a chart for you to plot the interest rate, your interest, and the loan amount. So you can see the performance of your loans and loan currency breakdown. What is the current interest rate? You can choose to do an action to repay, or you can click on the loan detail. So if you click on the loan detail, you are able to see a day-to-day breakdown of the loans, how much you have to repay, and accrued interest that you have incurred. Yeah, so it's a daily breakdown. So for you to make your own bookkeeping or record keeping, you are able to view the latest information. So loan history is also available. So this shows you all the day-to-day contract, daily breakdown again of all the transactions that have performed on margin, what is the loan interest that is being charged. So loan repayment, since it's clients are able to repay loans on the module, there's a new module that's added. So it's a very easy process whereby you just have to click on repay beside the loan. So once you click on repay, you can choose the currency that you wish to repay, and you can select the loan currency. You can select either the same currency cash account to repay the loan, or you can select a different currency cash account to repay the loan. So once you, of course, when you select a different currency, we will also warn you that, this is an FX repayment. So we need to wait for the FX to be completed first, which may take up to 2 business days, and residual interest may be charged during this period of time. Yeah, and then we will then offset your loan. Yeah, you're going to see on the GIF on the right-hand side, just enter your password, and immediately the loan repayment is being made. Okay, so cash withdrawal. Yeah, so this one has been mentioned earlier, how you can withdraw cash using the max withdrawal amount on the left and right-hand side. Okay, so you're interested in margin, you want to understand how you can view the different products and what is the LTV ratio they carry. So you are able to view this on the fund and ETF selector page. Just click on edit column, tick on the enable the LTV ratio, and immediately it's reflected on the column of LTV ratio. So you are able to view the LTV ratio on the stock and ETF order pair as well. So when you go to trade a stock, on the last column is the LTV. So when you are buying a fund, there will also be LTV ratio on all the bonds order pair. Also have a new column added. So we also be sending a new monthly margin statement. So this margin statement provides a monthly overview of your loans, how much valuation of your holdings, and what's the month-to-date repayment, what is the day-to-day breakdown of your repayments, and interest charges on a daily basis, opening and closing balance. Yeah, so to recap, now this multi-asset, multi-market, multi-currency facility is available now. It's newly launched on the platform. Please check it out. So we have up to different products that you can check out, which products are marginable. 3 times, 3.5 times leverage. These are the current promotional rates that we are running for as well for Sing, USD, and Hong Kong D. It's instant approval. It's immediate margin drawdown as well. So of course, this facility is for FSM Plus investors. Now, if you are interested to declare as a credited investor, other than having access to product financing, you are also able to access to Bond Express, special IPO for Hong Kong stocks, SGX IPO, as well as other closed door events that FSM will be inviting you. So if you have any questions, through this presentation, you're also able to consult our FSM investment team. Yep. So with that, that's the end of my slides.